Welcome to Spiedel's California Minute. I'm your host, Catherine Zidane. This week we're covering the tax treatment of CalPERS long-term care premium settlement payments. Spiedel's 2024 post-tax season update and review webinar covers answers to all of the questions that pop up during tax season, like the new beneficial owner reporting requirements and research credit developments. Get registered at one of 4 dates in May at caltax.com under webinars. We've recently been receiving questions from tax professionals asking whether settlement checks received by their clients who purchase long-term care premium insurance through the California Public Employees Retirement System, or CalPERS, in 2015 and 2016 are subject to tax. The Weddings v. CalPERS settlement involves a class action lawsuit for a subgroup of class members. The claim states that CalPERS breached the insurance contract with those CalPERS members who purchased a long-term care policy with automatic inflation protection benefits by raising premiums 85% for these class members. The inflation increase was announced by CalPERS in 2013 and implemented in 2015 and 2016. Those class members who opt for a refund of the premiums paid will receive 80% of the premiums previously paid during this time period. Many of these class members have received or will receive checks of at least $8,000. It's important to note that your clients will not have received Form 1099 miscellaneous reporting these payments because, per the terms of the settlement, CalPERS has no obligation to report or pay any federal, state, or local income tax or other form of tax on any payment or consideration made pursuant to the agreement. CalPERS has specifically stated that it will not be issuing any 1099s. Although these settlement payments are refunds of premiums previously paid, which would not generally be taxable, some of these settlement amounts may be taxable under the tax benefit rule. Under the tax benefit rule, taxpayers are required to include in gross income amounts they received that are attributable to deductions or credits they claimed in previous tax years. For taxpayers who received settlement payments in the Weddings case, this will only apply to those taxpayers who claimed a medical expense deduction on their 2015 and 2016 tax returns for these long-term care premiums paid or who received a pre-tax employee benefit. It's important to note that many taxpayers, as well as the IRS and FTB, may not have tax records going back that far. Remember that only those taxpayers who itemized and claimed a medical expense deduction, which would have required medical expenses to exceed 7.5% of their AGI during those tax years or received a pre-tax employee benefit, would have benefited from claiming these deductions. Also, for those who claimed a medical expense deduction for these premiums, the amount of long-term care premiums that may be claimed as a deductible medical expense is subject to an annual per-person cap. To stay up to date with California tax law changes, subscribe to Spiedel's California Tax Letter. This monthly newsletter is written by California tax pros for California tax pros in plain English with helpful examples and charts. For subscription information, go to caltax.com and click Publications. That's all for this week. Join us next time for another episode of Spiedel's California Minute.